Let me please introduce my guest this evening and someone who's special. Venu Shamapant, who is the co-founder of Live Oak Venture Partners here in Austin, Texas, which is a venture capital company, based on early stage firms and focuses on technology and technology-driven service companies based in Texas and the Southwest. I've got a tongue twister tonight, haven't I? Let me start. Prior to Live Oak, Venu was a general partner with Austin Ventures. He's invested and sat on the board of directors of Life Size Communication, which was acquired by Logitech, Spatial Wireless, which was acquired by Alcatel-Lucent, Navini Networks, which was acquired by Cisco, Manivir Systems, which is also publicly traded, and Sapira Systems, which was acquired by Avaya Communications. Prior to joining Austin Ventures, he was with McKinsey & Company, serving clients in the enterprise systems and software markets. He started his professional career as a software developer and an engineer lead at Mentor Graphics. Venu received an MBA from the Harvard Graduate School of Business, an MS in Computer Engineering from the University of Texas at Austin, and a BS in Electronics and Communication Engineering from Osmania University. Is that correct? Thank you. Venu is one of the founding members of TIE Austin, the Indus Entrepreneur, and he's also a founding board member of Austin Speech Labs, a nonprofit focused on providing affordable speech and cognitive therapy for stroke survivors. We're very lucky to have Venu here tonight. And Venu, tell us more about you and what you're doing.
Great. Well, first of all, thank you very much for having me come here. I'm not sure I would have shown up to listen to me at this time of the day, but I really appreciate the opportunity for me to share with you today a few things. What I thought I would do first, before I get started, maybe just a show of hands on how many people in the audience are students. Predominantly. Okay, great, because I just want to make sure I kind of tailor my thoughts towards, what you would want to hear. So when Laura told me the first 30 minutes I get to talk and I have a free mic, and I told my wife that, she said, well, Laura doesn't know you well, does she? Because nobody hands me a free mic for 30 minutes. So what I'm going to try and do today is to keep it really conversational. I'm going to talk a little bit about three topics, which in my mind kind of are things that you might want to hear. One is just a little bit of personal background, how I ended up where I ended up today. Talk a little bit about why we ended up raising a venture capital firm in Austin, why I left a big platform like Austin Ventures and raised a new fund. And then lastly, tell you a little bit about what Live Oak Venture Partners does. If there's anything other than that people are interested in knowing, just put your hands up and ask the question, and we'll do that as well.
And I'll encourage you to go to the mic when you ask a question.
So I'll start with my personal background. As Laura mentioned, I'm an engineer by training. Grew up in southern India in a city called Hyderabad. That's where I did my undergraduate degree in electronics and communications engineering. Thankfully, I don't remember any of it right now. Nobody would have trusted me with doing any engineering work anymore. But I finished my engineering degree in India, and then I applied to go to grad school. And one of the schools I applied to was the University of Texas. Just to give you context, my dad had gone to the University of Illinois in 1950s to get his master's, and had gone back to India in 53. And so when I told him I was applying and going to Texas, it scared the life out of him. He couldn't understand why I would ever want to go to a college in the Deep South, even though it was 35 years after he had been in the States. But University of Texas was one of those schools that basically met a very simple criteria for me. It was the highest ranked college I could get into at the lowest cost of education. And it's amazing how it continues to hold that badge even today. It's the best education that you can buy, the cheapest out there. So I came here in 1988, in the fall of 1988. I was going to do my master's and a PhD. I came in for both of those, finished my master's. And then I had that one semester after I finished my master's degree where I was starting to think about what I wanted to do in my PhD. And I had that fateful meeting with my advisor where I walked in and I asked him, so what classes do you think I should take next semester? And he said, you're not going to take any classes next semester. You're going to spend all your time on research. I walked out of that meeting completely convinced I had to get out of the program right away because I couldn't imagine doing one thing for the rest of my life, which is what I needed to do if I wanted to do a PhD. And so I came out of that meeting with my professor, decided I'm going to go work in the industry. And I walked over to the career recruiting office, and literally there were 2 companies left that were going to come for on-campus interviews. I didn't know who they were, but I just said I'm going to apply to both of those. And I was fortunate to get a job offer from one of them. So I left UT in the fall of '90 and went to work as a software developer for a company called Mentor Graphics, which was in California, and then eventually moved up with them to Portland, Oregon. So I worked for 3.5 years with them. And during that time period, it was a really interesting coincidence. One of my managers happened to be a very interesting individual who was a undergraduate and a graduate degree holder from Harvard, but who had then gone on to do engineering himself and had started a company which was acquired by Mentor Graphics. So my performance review day, he walks into a meeting with me. He has my performance review in a piece of paper. He puts it upside down on a table, and he told me, don't worry, you're doing fine. I'm giving you the best raise I can. But I really want to ask you, have you ever thought about going to business school? Now, you got to remember, I come from a family of engineers who never set foot into a business school class. And to me, that was a clear indication he was going to fire me in 6 months. He was just trying to get rid of me politely. And he made me a deal that day. He said, I think you have an aptitude for business. I'm going to get you a subscription for Wall Street Journal for 6 months. And you have to promise me you're going to read the paper every day in the night. And if you come back at the end of 6 months and you tell me you're interested to go to business school, I'll help you go to business school. So of course I did that. I read the paper. It was like a homework assignment every night. And at the end of 6 months, I realized I actually had an interest in the stuff I was reading in the paper. So he then helped me actually apply to business school. And it's not a complete accident that I ended up going to Harvard Business School, because that's where he had graduated from. I still can't, to this day, believe how they accepted me at Harvard Business School. I didn't know a thing about business when I applied. So I graduated from Harvard in '96 and came back to Texas with McKinsey & Company. So as my father says to me always, I'm expensively educated, but the jury is still out on if I'm well educated. So came back, joined McKinsey & Company. I spent 3.5 years with McKinsey. And for those of you who don't know McKinsey & Company, strategy consulting firm, did a lot of work analyzing things, writing a lot of charts, presenting ideas to management teams, and then walking out with the conclusion that nothing was ever really going to happen with those things. And it just got to a point where I was tired of doing that, drawing charts. And so after 3.5 years, I kind of got to a point where I had to make a decision on, do you stay and commit to becoming a partner at McKinsey, or do you come out and do something else? And I decided that I would rather come out and do something else, go back to the industry. And I was in Houston at that time. So if you wanted to be in the tech industry, you had to move back to Austin. And of course, I wanted to come back to Austin. So I started interviewing with companies here in Austin. And for those of you who know Motive Communications, it was a public company here, Austin Ventures portfolio company. And so I actually interviewed with them to join them in the business development team. During that process of interviewing with them, I had some people from the board interview me. And the people on the board were the people from Austin Ventures. So it was right around that time, late December 1999. Austin Ventures had just closed a brand new fund, which was going to double the amount of capital under management. So they had raised $800 million in the first 20 years, and they were going to close on an $800 million fund in 4 weeks. And it was a small group that had built the firm that were there, and they needed more people to come join them. So I was told that they never do this, where they steal people from their portfolio companies, but during that interview process, somebody asked the question, so have you ever thought about being a venture capitalist? And honestly, I had never thought of being a venture capitalist in my life. I thought I was going to be an entrepreneur. I thought I was going to build a product company, and I was going to have to interact with VCs on the other side of the table, but I never thought of myself as becoming a venture capitalist. But it was not a tough decision if you look at it. And in hindsight, having a personality disorder like mine, where you're basically attention deficit disorder, you can only do something for such a long period of time, and you get a chance to be in a firm that is going to constantly meet very smart people day in and day out. And you get to work with them, and it's a different challenge every day. It was just too good to pass it up. And as I looked at it, it was like, what's the worst thing that can happen to me out of this whole thing? I can do it for 2 years, and I say, I don't like it. I can go back to working for an Austin Ventures portfolio company, which is what I was trying to do anyway, to begin with. And so very quickly, it changed from I'm going to move to Austin to join a tech company to becoming I'm going to join Austin Ventures as a principal in the firm. So I joined them in December of 1999. And for those of you who remember that, December of 1999 was NASDAQ 4,500, which we've not seen since then, again, ever. So as I tell people, when I get into the industry, it's time for you to get out, because it was literally the top of the market, 4,500. And the 6 months after I came there, everything kept coming down and down and down. But I spent over 10 years with Austin Ventures. I started as a principal, made partner 2 years after I joined the firm, and then made general partner 2 years after that. Spent 10 years, invested almost $200 million in portfolio companies while I was there. It was absolutely the best time of my life in terms of my career. So that's kind of how I got into the venture capital business. Several people ask me this, especially students, kind of how did you become a venture capitalist and what should I do to become a venture capitalist? The first thing I'd tell you is I never thought I was going to become one. I was completely accidental. And the second thing I'd tell you is you never know where life takes you. If anybody had predicted 20 years ago I was going to be doing anything other than designing chips or systems or write software, I would not have believed myself at that point. So turn the corner, explore everything that you see. And most importantly, the biggest lesson for me from my career was the fact that mentors matter in your life. That one guy that showed up when I was working at Metagraphics who saw something in me that he said, I think you ought to think about going to business school, changed my life completely. So mentors matter. Finding the right mentor makes a big difference to you. And the flip side is turn around and once you're through that, become one too, because you have to take an interest in people around you, and it brings the best out of both of you as well. So that's a little bit of kind of my personal background.
Let me ask you a question at this point on the mentor side, Venu. If you were one of the people in the audience today and you were going to try and find a mentor for something you thought you wanted to do, how would you go about doing that?
Well, I mean, my experience was it was just happenstance in my case, right? It was the guy I was working for. But there were decisions that I made that probably put me in that place. As an example, when I applied to the University of Texas from India, I had a full ride free scholarship at the University of Connecticut, and all I had was an admission at UT. I had to pay for the first semester, take a risk that I might not get funding out here. And I did. And part of the reason I did that was, I looked at the two departments, and what I saw at UT was a faculty that was much bigger and much better known leaders in their community. And if you're around that, you're likely going to find people who are of that caliber that you meet. Similarly, when I joined Metagraphics, actually 2 different divisions in Metagraphics made me an offer. One was in New Jersey. It was an existing product line that would have been a safer bet for me to make versus this guy who I ended up working for, whose company, 3-person company, was just bought by Metagraphics. And so it was a lot more risky to go with him. But that's the chance that you take. And it's not all about job security, because I mean, I'm pretty sure there's nobody in this room that is going to have to worry about job security going forward. If you got into this school, into this program, you're smart enough that you're going to be gainfully employed for the rest of your life. Then the question becomes what choices you make along the way.
So it's
And,
choices.
and making those choices to put yourself in front of those kinds of people, that's what makes the big difference, in my opinion.
Good point. I interrupted you. You were gonna go on to talk to us a little bit more about why Live Oak.
Yeah. So I, as I said, I spent 10 years at Austin Ventures. I'm assuming a lot of people here have heard of Austin Ventures in town. Large firm, very successful firm, by far what I would consider the center of gravity for venture capital in this market. When I joined them, as I said, we just closed a brand new fund, $800 million in 2000, early 2000. Since I joined them, in the next 10 years, they raised another 3 funds, adding almost $3.2 billion to the capital that they managed. So they went from 800 million to 4 billion under management in 10 years. So it was fantastic time. The firm had grown immensely. The one byproduct of that growth was it gave young people like me the opportunity to take risks, to learn in that business. So I spent the first couple of years just basically carrying the bag, so to speak, for other partners in my firm who were founders of the place, and learned a lot about the business. I mean, I always joke about it, but I have, and Laura, you know the founder, Joe Aragona. I always joke about it, but I have my rules of Aragona. The first day when I did my first deal, I'd written the deal memo, brought it in. It was a $3 million investment, and the partnership had just approved this investment. And I was walking out of the room, the partnership meeting, and somebody high-fived me, and I high-fived back. And the founder of Austin Ventures, Joe, was sitting right there. He turned around and said, let me tell you the first thing you need to know about venture capital. You high-five and you get the money back in the door, not when you put it out. It's like, how hard is it to take a shovel and throw money out? That's the easy part. The hard part is when you want to get a multiple of what you put out to come back in. Sounds trivial, but it's amazing how many people ignored the basics in the business for the first 5-7 years of that industry's growth. But so I learned a lot about the business while I was at Austin Ventures. I had a very successful track record. I'd invested in some very successful companies. I can honestly tell you, as hard as the venture capital business is on the inside, I know none of you think I have a hard job, but trust me, it's a hard job. Because what you have to remember about being a venture capitalist is it's inherently a masochistic job, because if you have 7 companies or 10 companies you're working with, when you wake up every morning, which is the one that you're going to think about all the time? The company that's about to fail and you're going to lose all your money because you want to go do something about it, right? So the highs are great. You get short, narrow peaks, but the rest of your time you're spending on the creaky wheel, and it's the deals that are not working all the time. And so, when you go through that atmosphere, you learn a lot about what drives you. It's the people. It's what drives you. It's having partners that you worked with that drives you. And what I gravitated towards with a particular interest was to work with very early stage companies. So several of my companies were literally 2 guys that walked in to the door and said, I think I know how to do this, and I think I can build a business out of this. And I literally incubated several of these deals where we would bring the entrepreneur into our offices. We would give them what we call the mortgage money, so they didn't have to kind of leave their houses, but put them in a room, worked with them to develop a business plan, helped them put a team around it, and then took them from standing start to a real business. So the first example of that was this company called Spatial Wireless that I did in Dallas. An entrepreneur who, like me, was an Indian entrepreneur who had come to the United States, was working in the telecom industry. I met him at a Thai conference, and he came up to us and he said, I think I know how to build the next generation of wireless infrastructure at a fraction of the cost of what Lucent and Alcatel built. very audacious claim that I wasn't completely sure, but we seeded him with the first $500,000. We put him in our office for 6 months. We introduced him through our contacts to several customers in that market, validated it, and then we led the Series A. That was in 2001 January. By 2004 December, we had a company that had a product that had sold $100 million worth of wireless switches to carriers like T-Mobile and Singular, and I had sold it for $300 million. There were probably 20 millionaires that came out of that company. And the high of doing that is what keeps you in this business. It's, as another one of my Aragona rules, venture capital is a get-rich-slow scheme. It's not a get-rich-quick scheme, because it takes a lot of time for you to build companies. And if you don't have the patience to be there long enough to see the returns from multiple of those working, don't get into it, because you're not going to come into it in 4 or 5 years, do something dramatically to change your fortunes. So that's what I liked about the business, that early stage, being able to work with those people. And so I guess at some point you could call the entrepreneurial bug got into me as well. There was something attractive about building a franchise of firm, a firm that would be in this market, that I could say was something I put in this market. And added to it, I had a couple of partners that I had worked very closely with. So we were 3 partners that founded Live Oak Venture Partners. Myself, Krishna Srinivasan, who's also a partner with me at Austin Ventures. We were together for most of the 10 years we were there. And then finally, a gentleman called Ben Scott, who came from a very different background, more operating than venture, but had worked with us for the same 10 years. And so we all got together and we wanted to work with each other, and it was just, we knew we could complete each other's sentences about what was working and what was not at our portfolio companies. So the first thing that led to the formation of the firm was the fact that I had 2 partners that I wanted to go do something separately with. The second thing that surprised me was, if you look at the Texas market, it's the most supply-constrained, demand-rich market I've seen in terms of a venture capital market, an entrepreneurial market in the country over the last 10 years. It just blows my mind away. If you think about what makes venture capital tick, the top 3 things are talent. Texas is the 2nd largest tech employer in the country. Research. The University of Texas system alone is number 2 in the country on R&D budgets and number 3 in the country on invention disclosures, 2 to 3 times more than Stanford or MIT individually. And so we have that. An ecosystem, which is the last thing you want. Success stories that spur others to say, I can do that too, and I know Jimmy did that, I can do that too. And this market puts out $2 to $3 billion of venture-backed exits every year. So you have the talent, you have the research capabilities, you have the ecosystem. So what was missing here? And as we looked at it, from my perspective, what was missing was early stage capital locally. It's the ability to get an entrepreneur who had a bold, audacious idea to come out and do something about that idea. And some people and certain businesses lend themselves to doing it in a bootstrap model, and some don't. If you're doing a consumer internet site, maybe you can take the risk and bootstrap that, but if you're building the wireless switch, you can't do that by quitting your job because it needs more capital than that. And our read was, what had changed was the capital situation locally. And there were a couple of reasons for it. At a macro level, the venture capital industry has shrunk dramatically. To put it in perspective, 2001, the year I came into the business, the first year after I came into the business, venture capital funds raised $125 billion of capital. Just think about those zeros for a second, right? And if these things have to deliver a 3-4 times return, they had to deliver $500 billion of value, which was way bigger than the industry could have supported.
And at that time, Texas was the 3rd to 5th largest market for companies to receive.
It was the 3rd largest market. It was the 3rd largest market at that time.
Right.
So in 2001, $125 billion. And the average for the last 3 years is $15 to $17 billion. So the market overall has shrunk 90% in terms of the capital coming in, which is not all bad. I actually think that's necessarily a good idea because there's got to be some friction for capital, number one. But the thing that actually made it worse were the trends underneath the top line number. And there were two things that really hit Texas badly. One was the money that, even though it was less money, it was getting more concentrated in a few large firms. And increasingly, those few large firms were on the coast. So what happened as a result was you really didn't have any more local capital other than Austin Ventures in this market, and some of these guys coming in from the coast. So we thought that was an interesting opportunity to try and raise a new fund that focused specifically on that market opportunity for us. And you can look at the research in venture capital. It tells you very clearly, unambiguously, funds 1 through 4 for a new family of funds. So like our new Live Oak Venture Partners is Fund 1. Funds 1 through 4 historically have the best returns, and around $200 million is where venture capital returns start to plateau out. So if you raise a $200 million fund versus a $500 million fund, your returns start to plateau out. So there's very strong evidence that small, focused funds can have great returns. And so that's the opportunity that we saw. Now, having said that, I'll tell you, if you haven't already picked up that my timing tends to be not very good, I picked the absolutely worst possible time to raise a first-time fund in the history of venture capital. It was ridiculous. I mean, the shrinkage in the macro markets was so bad. We would go into these meetings where people liked the team, liked the strategy, liked the track record, but they were coming back from, I have 45 relationships with venture managers, and I'm shrinking to 15. Why am I going to add a new manager at this point? So it was just absolutely the most horrible time. And for anyone here who thinks raising a venture capital fund is sexy and wants to do it, let me tell you, the hotels you get on Hotwire in exotic locations like Springfield, Illinois, Albany, New York, St. Louis, Missouri, trust me, you could do better than go all those places. But that's what we had to do. It took us 2 years to raise the fund. Took us 2 years, probably 500 meetings. I can't even remember how many people we met. Over 300,000-400,000 miles of flying around to raise the fund. And there were a lot of dark days where we just thought it was not going to happen. But there were a couple of big limited partners who had the foresight to say, we're going to do an emerging manager program. We're going to define it in a way that allows people like this to come into that program. And they literally put us in business. They made the commitments to us, the first set of commitments to us, and put us in business. So fast forward to the end of that story. So we raised Live Oak Venture Partners. It's a $100 million venture fund, which is our target. It's predominantly backed by institutional investors, which is pension systems, endowments. Lots of family offices have supported us. And we've got a few individual investors in our fund as well, but very small piece of it.
But that's very, very unusual. Most first-time venture funds are backed by high net worth individuals until they can get to meet the institutional investors.
That's very true. And partly that was by design, which you could argue was self-inflicting damage on us. But our belief was two things. From a strategy standpoint, we wanted to be people that could invest in the life cycle of a company, which meant you have to have a fund of a certain size to be effective. If I raised a $20 million fund, I could do a lot of Series A, maybe C deals, but I couldn't keep investing with the company as it grows. And we strongly believed in being a cycle investor, number one. So that dictated a certain fund size, which naturally put us beyond just an individual and family office kind of program. And the number two part of it is institutional investors tend to come back and support the funds again and again. So in some ways, we feel like we took the hard part of the effort up front, and hopefully it's going to pay off on the back end of it. If we deliver on the first fund's results, we have investors that have the deep pockets and that have already got the confidence in us that they'll keep coming back to us. So that's what led us to this dichotomy of, we could have closed on a $10 or $15 million fund and gone out to put that money to work, but that severely would have limited the kinds of deals that we could do, the kinds of investment strategy we would apply, and we didn't want to do that. So that's why we ended up with this structure.
Tell us more about the kind of deals you're going to do.
Yeah, so let me tell you what we are doing at Live Oak Venture Partners. we're basically early stage investors. And we're driven by four things in our strategy. The first and foremost is we're technology and technology-enabled services investors. So what that means for us is traditionally information technology-driven companies. When we see technology, it's IT. So we're not medical devices. We won't do any pharmacology. We don't understand that stuff, so we're not going to try and do that stuff. So tech and tech-enabled services. And people ask us, why that? Primary reason for us is we're looking for businesses that can show some sort of operating leverage as it grows. And the leverage can be, I need another $1 billion to go build a factory. The leverage can be, I'm going to hire the next 500 people because it's a headcount-driven business. It has to be something where technology gives you an unfair advantage. So that's the first lever, tech and tech-enabled services. Then the second thing that we talk about is we prefer to be the first institutional capital in a deal. And this is a little bit more tricky because we think in about 70 to 80% of our deals will be the first institutional money in the deal. So there are going to be deals where we will follow another investor who's already in the deal. But the reason for us that that's important is because it allows us to get involved early and shape the company and the team that's working on that. We think of ourselves as partners, not investors. And that's a big part of our strategy that's worked well for us. So that's kind of the second piece, first institutional capital. The third piece for us is a focus on Texas and the Southwest. And this is another one where people ask me, here's a guy, here's two of the three partners born and brought up in India, came to UT. What do you like about Texas? And why do you want to focus on Texas? And it's not about Texas. It's the fact that we strongly believe venture capital is a neighborhood sport. You have to be around the company. You have to know the entrepreneurs. You have to have some differentiated access to deal flow that gives you a chance to see something before anybody else sees it. If I go to California, I mean, you can't throw a rock in the air on Sand Hill Road and not hit a VC in the face with it. What advantage am I going to have when I go see a deal in California? Another one of my Aragona rules, Joe used to always say, every time you get on a plane to go to California to look for deals, button up your back pocket because your pocket's going to get picked. And I learned it the hard way. One of my very early deals was a deal in California, and I lost all my money on it promptly within 2 years. So we believe we have the quality of entrepreneurs here that we can fill a good fund with, and we have the added advantage of being local, knowing these entrepreneurs, and seeing them before anybody else sees them. So the question for us was, why not why Texas, but why not? And then the last dimension for our strategy is we're active investors. And what that means is we're not going to be passing by investors. We're not mutual fund stock pickers. We don't want to put $100,000 to buy 2% of the company. We want to have enough ownership in a deal that if it works, it impacts our returns. And number two, on almost all the deals we do, we are going to be on the board of the company when we make an investment. Because again, we view this more as a partnership rather than just an investment. So that's kind of what we are thinking about from a strategy perspective. So to put it in context for you on how we've operationalized it, we've just finished our first year as a fund. So 2013 was the first year that we were in business. We made a list of the number of deals we saw. So deals that came in and companies that came in and met us in the office with at least one or two partners in the meeting. We met 180 companies last year. And we put out 6 term sheets, so terms of investments for 6 companies. We closed on 5 of the 6 deals. 4 of those were companies right here in Austin, and one of them is a Houston-based company. Ranging all the way from, we have a $250,000 angel-like seed investment to a deal that's a $500,000 with a convertible note with a predefined Series A investment to traditional Series A investments. The entire spectrum of the deals that we've talked about. We plan on incubating companies in our office. We've got space for that. But our model on how we work on incubations is very different than what you might hear from other incubators. We're not a volume-driven incubation place. We're not going to have 15 companies go through our shop in a year. We're probably going to pick 2 or 3 people. But our difference is we expect that if we take you on as a seed investment, that the probability of becoming a Series A has to be very high. We want to bat 1,000 when we do incubations. So it's not a larger ticket business.
So of those 6 term sheets you put out, what made you pick those 6 out of the 180? Was it because you had a strategy where there's a particular area in IT that you were trying to find? Or was it because the entrepreneurs who came to you presented you with an area that perhaps you hadn't quite thought of, but had a compelling argument?
It's a little bit of both. I've tried to figure out how to put the answer to why do you pick the deals you pick into a very succinct answer, and there's really never one, right? As I said at the very beginning, we're not a market segment-driven investor. We're very opinionated about what market segments we like, but I'm not going to be one that's going to come out and say, we want to invest in cloud, or we want to invest in wireless. And the reason I don't say that is, if you look at the history of venture capital, trends come in and trends go on. The successful firms, if you look at a Kleiner Perkins or a Sequoia or Austin Ventures, these are not firms that said, I am an investor in this technology. These are firms that built a franchise by saying, I'm an investor in the best entrepreneurs, and I know how to find them before anybody else does. And so in that sense, our strategy is very much a people-centric strategy first. Then it comes down to where do you have an unfair advantage after that? The very first deal we did, which was, by the way, very painful for a partnership that had 2 Longhorns to actually approve the investment, was a spin-out from Texas A&M. So, you guys know what I'm talking about, right? I mean, 25 years after graduating from here, the first deal you do is an Aggie deal. Well, it had a great technology.
We'll give you an opportunity to rectify
exactly.
that.
I'm waiting for that to get fixed. But, so that's an example of a spin-out of a technology from a university that we really liked. It was in a market that I would have never thought of in industrial markets. Mm-hmm. We liked that, and we did that. And then the other side of it was literally an entrepreneur that reached out to us through the website email address. So most people will tell you, go to VCs through your relationships. And I agree with that. It matters. If Laura sends somebody to me, I've known Laura for a long time, I know how to calibrate it. She's not going to send me somebody she doesn't think is worth my time. So that helps. But the flip side I want you to know is we have a place on our website. It's called info@liveoakvp.com, where anybody can send, or plans@liveoakvp.com, where you can send an email saying, I have a plan, here's my presentation, I want to come meet you. Literally got the Houston deal we just did, was somebody that approached us through that. And we took the meeting with him. It was a great entrepreneur. Interestingly, the youngest graduate of Harvard Law School at the age of 19, who was starting this company. It was in the legal software business, and we ended up doing that deal. So it comes from all over the place, and I'm not sure there's one cookie cutter thing that we do out of that.
But the people are very important. I'm going to ask those of you that might have questions to please go to the microphone, so as I can see that you have a question. I'd rather if you would head to the microphone, that would be great. Either one. Yep. But people are very important in this process.
Absolutely.
Not just your partners, but the people you're investing in.
Absolutely.
Great.
Number one criteria.
So I have a question for you.
Yeah.
You had mentioned that you're dealing with emerging companies at the root level, whereas other companies are investing mid-market. You take on a lot of risk when you're dealing with these startups.
Yep.
And as a VC, I'm sure you deal with, and have seen in your past many failed projects. What do you assess with these companies? What is your assessment to decide whether this is something we want to go forward with or not? Because you're talking about a lot of money on the line.
Sure.
And what are some of the steps you go through when you're deciding who you want to deal with?
Yeah.
And then another quick question.
Sure.
Also, from what I've noticed, I've had the opportunity to intern with a PE over in Shanghai, and a majority of the people I was working with were older and had built up rapport in the industry. I feel like it's not something that many people can graduate college and say, hey, I'm here. I just graduated. I want to be a VC.
Yeah.
What is your opinion or advice for the steps that someone should take to position themselves to possibly get into the industry?
Sure. Well, I mean, on the first question on how do we kind of due diligence deals and decide which ones to put on, how do we think about risk mitigation? The first thing you realize, I mean, in the first couple of years of working in the venture business, I was looking for a risk-free deal, and I quickly realized that was a null set. There weren't any. So the first conclusion you come to is you are going to take some risk in the deal. The question is, what kind of risk are you willing to underwrite? And it's driven by how can you control that risk, right? So if you think about it at a high level, almost everything we're doing tends to have some sort of a technology risk. Can this company build what they claim they're going to build? Because it's hard for anybody else to have done it so far. Why these guys? Secondly, you can take market risk, and there's a potential for size or timing. And the more dangerous one is timing, to be honest with you. Because when you have a market that takes longer to develop, you burn more money. It's not as capital efficient. Your returns get eaten up pretty quickly. That's the second one. There's an operational risk you take, which is just execution. Sometimes you have the right technology, the right market, but can the team just execute like clockwork? And then you take financing risk, right? So is there your ability to finance a company? I mean, I might find the best deal for an automotive parts company, but find me a VC who's going to put money into that today. It's not a market that VCs want to put money into. So there's financing risk. And then lastly, we call it the neighborhood risk. And what I mean by the neighborhood risk is you can have the world's best house in the bad neighborhood. It doesn't matter, right? And people don't understand that completely. There are some very good businesses that are just not good venture capital backable businesses. And there's a distinction between those two things. You can have some businesses that are revenue-based, that you can bootstrap, that are great businesses for the entrepreneur to go start. But they might not be great businesses for us to invest in because they don't have the potential to break out. So we think about all of those dimensions of risk that we're taking. Now, our macro way of thinking about a deal is I want to minimize compounding risks, right? So I don't want to take a risk on a team that's very junior, so has a lot of operational risk, and couple it with a market timing risk. It's like, okay, now you got, so the fewer you take, the better you know which risk you're trying to fix, when, how much capital does it need, how much time does it need to go figure out if you can fix it. So that's the macro way we think about risk. And the second thing I'll tell you on our losing all our money kind of thing, in venture, you can lose money with your initial investment decision to put money in a company, but it's my hypothesis that you actually lose more money in follow-on financings in your company than the initial investment. What happens is you fall in love with your company. It's that entrepreneur it's the story you bought in, it's the story you convinced your partners was the best thing since sliced bread. And now they're behind by a year, the market's not happening, but just $2 million and we're going to get there, right? It's easy to incrementalize yourselves into this decision. So the hard part for us in our firm, and we make it a very conscious effort to talk about it, is follow-on investment is as important as a brand new investment. And if you don't think about it that way, you can actually lose a lot of money. So that's a long way of answering your question on kind of how we think about risk. In terms of kind of career path, my first question is, why would anybody want to be a venture capitalist? I mean, seriously. It's an industry with 1,500 people in the country. It's a small cottage industry, right? So breaking into it is, I was fortunate. I was there at the time when it was 7,500 people. I was around people that gave me an opportunity to learn the business, but it's a tough business to break into it. The best way I can think of, or I can suggest to you, is to start with the portfolio company side, if as an entrepreneurial, or just joining a smaller startup company. And the reason that becomes important is I can't tell you today what makes a venture capitalist successful. It's not a rule book. You develop a certain experiential base to make decisions on, and that's what you're trying to get into places that are going to teach you that. Now, if you go join an IBM as a development engineer or a business development person, the odds that they will trust you to make those decisions are low, just because it's a bigger organization. There's more checks and balances. You're in a 6-people company. The CEO can't do everything. He's going to tell you, go figure it out. And so that's what I would tell you is a better place to do it. But look at the successful VCs in the market. I mean, Mike Moritz at Sequoia was the guy that invested in Yahoo, the guy who invested in Google. He was a reporter for Time magazine before he got into the venture capital business, right? So there's a lot of ways you can come at it as long as you develop that perspective.
Do you think the venture capital business is really an apprenticeship business to some degree?
I think it is, but I'm not completely convinced it's an apprenticeship business from other partners to you as much as it is from entrepreneurs to you.
To you.
And I think that's a distinction that people, like I was at McKinsey and Company. McKinsey is considered an apprenticeship business too, but you're learning from a senior partner how to do the business. Right. You are learning from senior partners in the venture capital side too, but you're learning a lot more on the company side of the business. So, when I came on, as I said, I carried the bag for the first couple of years on deals that were not my deals, but it was great to just go in and see how other people interacted with their portfolio and, made their decisions and all of that kind of stuff.
That's great. Other questions you may have? Otherwise, I have a lot more. Please, could you please come stand at the microphone so we can get the questions more quickly as we go along? Thank you. Sir.
Hi. My question is, as a startup, especially for companies into information technology, on what basis do you value the company? On what basis do you base your valuation at the startup stage? And if they have an exit strategy at the end of X number of years, especially for software startups, how do you value it?
Well, the shortest answer is, honestly, valuation is not a science at the early stage. There's really not many metrics that you can base your decision on. Somebody's got a brilliant idea and comes to you. It's not a science to it. It's one that, at the end of the day, market decides. If I say it's worth only $2 million pre, and it's a great idea that 4 other VCs are going to put money on, it naturally works its way out. So I think the valuation at the early stage is less driven by any scientific metrics, but it's the parameters that go into it to make the decision are how much capital will you need, right? Not just in this round, but in future rounds of financing. If it's a company that's incredibly capital efficient, you'll need $2 million and you can be profitable, and I can believe that plan, that lends itself to a different kind of valuation than if you said, I need $8 million in Series A and I need $45 million before this gets to cash flow break even. Because there's only so much ownership you can give out with that money, right? So the capital requirement plays a role in it. Number 2, the breadth of the team makes a difference in the valuation. If the founding team has enough people on it that I know that the company is going to be valued through that, that I don't have to come out of more option pool and take dilution in the future, that improves your valuation. So there's parameters like that are intuitively driven into it, but I'm not sure I can give you a firm answer that says this is exactly how we would value that.
So isn't the VC rule of thumb or
In a way, I guess. In a way, I guess, yeah. And to your question on exits and valuations, honestly, I strongly believe companies get bought, not sold. Because when I've sold companies, it usually means I'm recovering my capital or I'm trying to recover my capital. And when companies get sold is when you get strategic premiums on it. And the valuations for those companies almost never has any rational basis. You tell me, is Snapchat worth $3 billion today? It's what the market pays for it, right? And that's a strategic premium. So again, valuations are part of it, but almost never a very scientifically driven thing from my perspective, at least.
Great. Sir.
Just following up on the question about the risks, how do you, I just want to know a little bit more about how you assess operational risks and execution. Which aspects of a team from the first few meetings tell you how risky that is?
Not easy, as you can imagine, because that's always the thing that you look for is a lot of times when we do due diligence on the team, we make reference calls on the team. Actually, increasingly, if I can find people in my network that know the team, that I can go call and say, hey, I see you know this guy on LinkedIn. We're thinking about investing in his company. What do you think about him? What should I watch for him? Again, remember, I don't believe that I can go in saying I can eliminate operational risk. All I'm going to look for is where is the risk and how do I mitigate it? So sometimes we'll find out, everybody on this team is great, but that VP of engineering, be careful because he tends to be a perfectionist. He'll take a long time. as an example. What I want in that case is not replace the VP of engineering necessarily, as in having a CEO that understands that balance between time delayed for a product versus what it impacts his business, right? So a lot of reference checking, lots of looking at historical experiences. Those are the kinds of things that you would do to mitigate the operational risk.
All right. I just have a question regarding Mavenir. Like, it recently went public. So, what was your decision making, your influence into that process of making that company public?
Well, I mean, again, that becomes more. It's really not necessarily something where we sit in a dark room and decide we're going to take this company public. It comes back to, if you look at the history of venture capital, 90% of the deals, and I don't know if it's 90 or 80, but a big proportion of deals get bought. They're strategic exits. And that's because, in a large way, this market is very much an outsourced R&D for the big companies market. There's few companies that have the potential to be standalone businesses, that have the ability that they're in a big enough market, they have a sustainable advantage, and they have the capital to continue their growth. When you have a company like that, you try to take that public because then you can play the company longer and hopefully improve your returns on it. So I'm going to be very careful not to talk about Mavenir in particular because I'm on the board and it's a public company. And I've been told I don't look good in orange jumpsuits, so I'm not going to talk too much about the specifics of Mavenir. But that's the criteria, is do you want to play on, do you believe you have a good hand that you can play longer and improve the value on? And if you believe that, and the market can support a public offering, then you raise the money. But the important thing to remember is a lot of people confuse an IPO with an exit, and it's not. An IPO is another financing event for the company. And as long as you understand that and you know why you're doing that and that you're going to defer your ability to get money out for another 12 to 18 months, you're making a calculated risk just like it is if I'm making a Series B investment. I can sell the company today, but should I invest another $3 million in it because I think the value will go up? Or do I take my chips off the table? So that's the same process for a company like Mavenir to go public.
So whether it's around a capital or it's an IPO, any new cash into the company is just another starting point to raise the company to the next level.
It is, with more information.
Right.
Right. I mean, I know a lot more when I'm looking at a Series B or a Series C because I've spent the last year or 2 years working with those entrepreneurs. And there are a lot of times things happen and unforeseen situations show up and companies don't hit everything that they think. And that's anticipated. But we're making a much more educated investment decision at that point. But you have to force yourselves to kind of step back from, I'm doing this to protect my existing bait. You have to think about it as, is it something I would, as an outsider, make an investment in?
So your decision-making process in Live Oak, every venture capital firm has a different way. Sometimes it's an individual partner has an allocation of capital. Another time it's a group decision by all partners.
Yeah.
What kind of decision-making process for those 6 term sheets did you go through?
Yeah, no, so the advantage of a very small partnership with 3 guys is we can make the decision really quickly. We've explicitly decided that we're going to be a unanimous partnership when we make an investment. It just drives a very different cultural dimension to it. I mean, when you think about it, here are 2 partners that I've worked with for 14, 15 years now. If one of them is very vehemently opposed to an investment, I think the best thing I can do is step back and say, why would they be so opposed to it? And if I can't it doesn't mean I'm going to give up without a fight.
Right.
We're going to try and really convince them. But if we can't convince them, then there's a really good reason to let the deal go and come back and look at the next round of financing on that. So we're very much a unanimous requirement for it. And the other part that culturally that drives for us is now every portfolio company has every partner fully committed to making it successful, as opposed to you did the deal when I said don't do it, first piece of bad news, and you start the grave dancing around it.
Right.
You don't want to be able to put the company in that position either.
Right.
So we very vehemently believe it should be a unanimous decision.
As an early stage investor, are you taking a board seat in every single deal?
Absolutely.
And is it the partner that brings the deal to the table, or do you reallocate that board seat as things evolve?
It's typically the partner that brings the deal to the table, but we've also had situations where it made more sense for another partner to be on the board, or in some cases where we've had two partners go to the board meetings. I mean, as I mentioned, my third partner, Ben, comes with a lot more deeper operational experience than I do. And that's how I met him, was he came in as a venture partner at Austin Ventures. And I was the guy that found the deals, that did the deals, but Ben would also join me on the board of these companies. And when we got into things like sales compensation design, how do you think about a company going from $0 to $5 million is very different than a company going from $50 to $150 million. The problems are completely different. And so having, in that case, my partner was much more qualified than I was for some of those things. And so we teamed up on those kinds of things. We would both go to the board meetings. And on issues like that, he would take a lead on it. If there were financing related issues, I would take a lead on it. So we tend to do it both ways.
How many boards do you think a venture partner is able to adequately sit on when you're finding deals, running the business of your venture capital fund itself, which is a business all
Sure.
on its own, and kind of helping these companies?
Yeah, I mean, it's not an exact science there either, but I'll tell you what changes for me. It depends on where in a life cycle of a deal your company is. Right. So if it's an experienced entrepreneur and it's 3 or 4 years, he's got a complete team on board, those companies can end up being almost no load to us, right? So if I have the guy I told you, Spatial Wireless, Pradeep came back to run Mavenir, so he's a repeat entrepreneur. It's his second company with me. The first company at Spatial Wireless, every morning at 8:30, I would have a call from him saying, what do I do about this? What do I do about that? Let's talk about this. Let's talk about that. At Mavenir, I never heard from him because the guy knew how to build a business. He knew how to run that, and he hired a team, and he was off to the races. So it depends on what kind of deal. So a deal's not a deal. It depends on the specific kind of deal. But our sense is, I think, 5 to 7, kind of, from a rough swag, I think is a reasonable load for a partner to be able to handle, right. Especially if they're active, heavily active deals.
Right. Thank you, Venu. We are very serious about making sure you have time to network directly with our guests tonight. And you've given us a lot to think about. One last thing I'd like to ask you for this audience is, and how much time are you going to spend investing in UT deals this year?
Well, I mean, in all candidness, we would love to do more stuff here. Honestly, UT has improved a lot along a lot of dimensions, but it's relatively still a maze that is hard to kind of get through. I mean, you compare a school like Stanford, as I said, 1/3 the invention disclosures as UT, and then you look at what comes out of there versus being, at UT. There are certain restrictions that come from being a state school, and I understand that. It's not the most straightforward of things to do, and we're improving that. But we would love to spend more time here. We've spent a lot of time with the engineering people. We tend to come to, I judge the mock, the presentations, the business plan competition, for example. I would love to see those kinds of things. I mean, nothing would make me happier than getting a chance to come back on campus all the time. So anybody that has an idea, you know where to reach me.
So Venu, Shamapant, we really thank you for being here tonight. This has been fabulous. Thank you so much.
Thank you.